This is a weekly video uh, where I'm trying to cover various topics, but I'm broadly going to cover where I feel Nifty is right now, uh, how are the mutual funds selection could be done at this point, what are the stocks that I am tracking, a very small list, key events that I have, and a couple of offerings that I have for all of you to learn things that I have learned over in the markets over the past few years. Now, in terms of the Nifty valuations, you can see this black dotted line in between, which is basically the median PE of over with data of over about 28, 26 odd years. Now, right now, the median PE is 20.9, and the current PE of Nifty is around 22.26. This in itself is a clear indication for me that Nifty is in a completely overvalued zone. Yes, not by much, but still overvalued. What is that telling me? That tells me two things. One, that bullish trades in most cases are going to fail. The wider bias of the markets only based on valuations, not on levels, not on liquidity, nothing of that, only based on the valuations is on the corrective side. Now, this can change, right? If the earnings pick up very well for the next 2 or 3 quarters, then even Nifty staying at the same price could bring this P below the median value. That will begin the hunt for some of the quality stocks that are available. So, in terms of Nifty, I'm in the overvalued zone, slightly overvalued, but yes, in the overvalued zone. Now, what does this mean for me when it comes to brand new investment, when it comes to putting more money on to the markets? It's a cautious time for me to not go and aggressively allocate funds. Looking at what I have in terms of the bargain stocks and what I have in terms of the broader structure, you all know this query that I've shown this enough number of times. I only look at market capitalization greater than 1,000. Valuation to median is zero point 0.7. I'll explain what valuation to median is. Average return capital is, you know, of for 5 years around is at least more than 10%. Uh, the free cash flow for 5 years is greater than zero, which means I'm at least with a positive cash flow and I'm avoiding any SME companies, right? Purely because I do not have the risk appetite to play into SMEs. Uh, I'm very much a large and mid cap kind of personality. I do not like my stocks to go down very much. Yes, I do make investments in small caps in certain times, but no, that's not my preferred approach. So, basis this filter, if you see, we only have about 33 stocks that are coming out in the result. You can see all the stocks. I'll share the query in the description. I've arranged all of these stocks by market cap. So, my preference is if there is a stock of a higher market cap that is giving me an opportunity, then I will prefer that stock over a lower market cap just because of the stability, just because the amount of manipulation that is, and chances are reduced in a large cap stock. Now, this applies to stock, and like I said, this comes from the original diagram here that the valuations have to go below this for me to aggressively allocate any funds at this point. Okay, now if we go on to look at some of the mutual funds, now in mutual funds, my theory is completely different from what people do out there, what people advocate out there, that you continue to do SIPs even on rising months. You make it a habit to invest on a monthly basis no matter what. That's not how I trade. That's not how I invest in mutual funds. For me, the rule is very simple. On Any candle where Nifty has done a monthly negative candle, that's the point where I want to invest a certain amount in my favorite mutual fund. Now, how do I select mutual funds? Now, if you see, there are some filters applied here, but broadly, these filters are very simple. I want my PE ratio that you see here to be lower than the Nifty's median PE ratio, which is 20.9. Anything below that, I am okay to invest in as a mutual fund, provided we have a negative candle in Nifty that's available and has closed on that month, right? So let's look at a few funds, and I'm only going to look at 6 to 7 categories. You have so many categories in equity, but I think 6 to 7 categories will give you a good amount of funds to invest in. Over diversification of funds is also not good. You will lose out on returns. So I try to pick one fund per category, no matter how lucrative the other funds look like, how big are they in terms of the names on the marketing side. So if I look at large cap, I only have DSP large cap fund that's in the category right now. The expense ratio is less than 1, which is a very good sign. Why not Taurus is because if you see the AUM is very low, right? And this is something that I don't prefer. Contra funds, the funds that invest in counterintuitive ideas. There's only one fund available at this point, SBI Contra Fund. It is also one of my active investments right now, and the P ratio is around 18.2. And I keep watching this. Okay, I do not want this to go above 20.9 by a very big margin at this point. If you look at FlexiCap Fund, I don't really have to name it. Parag Parekh holds the highest priority here with a very low expense ratio of 0.63. That's the best thing I like about PPFAS. It's very good in terms of expense management. If you look at the mid caps, then we have Quant Mid Cap Fund again with 17 as their um, P ratio. Now again, see for someone who is a personality like I have, where I do not prefer large cap uh, uh, apologies, I do not prefer small or mid-cap direct company exposures, can look at such funds to invest through so that you don't have to actively manage your investments, so that you give your money to someone who is performing well and who is at a valuation that is lower than the Nifty's median valuation at this point, right? And of course, expense ratio matters. I do not want to invest in a mutual fund that has an expense ratio of more than 1%, right? Because that eats into your returns. Let's not forget that. If I look into small cap, there is only one fund, Bandhan Small Cap Fund. Again, very good expense ratio, very good P ratio at this point. I do not want exposure into sectoral funds because sectoral funds I can get exposure via ETFs. Value fund is again one of my favorite areas. Value funds in terms of the P ratios, if you look at it, the best valued fund at this point is Tata Value Fund. Yes, the AUM is slightly less. Yes, the expense ratio is 0.81, but it's one of the best place in terms of undervaluation as compared to Nifty. Okay. And the last category, if you are someone who loves to save tax by doing a ATC investment, then in terms of investments, you have Sundaram LT in terms of valuations, these two, Taurus and Sundaram. But if you see the expense ratio goes well beyond 1%, not interested in those, then the next obvious fund is going to be Parag Parekh ELSS tax saver fund. Now, I do want to remind you that tax saver funds come with a lock-in period of about 3 years where you cannot sell. It's a close-ended fund. You cannot sell your investments for 3 years. It's a complete lock-in. So those are some of the mutual funds. If I have to put them in categories, I've already put them in categories. Probably next time I'll put it under a watch list with the favorite ones that I have, right? Now, I, as a lot of you know, sometimes trade into the futures and option segment, and it is very important for us uh, who trade in futures and option segment for a period of days, a few hours, or a few days of the week to always know what are the key impact events that are going to happen in the coming week or in the coming month. Now, the key impact events of some sort were have already been done. The budget is done. The Reserve Bank's interest rate decision is done. So for this month at least, we have the inflation rate coming, but it's all after the market hours, so I'm not very worried. But broadly, if you see, there are no big high impact events. Yes, there is some manufacturing PMI, services PMI coming in on February 20th, but broadly, we don't have very high impact events uh, at this point for this entire February month, which gives me a good sense that we will have good areas to trade this month if the setups come out as we expect them to. Now, there are two offerings that I have which I wanted to speak about. One is I have taught how to create the bargain stock list and how to relate with it on a day-to-day basis and how to keep your mindset realistic in terms of returns. That is what I teach you in the self-paced learn to select strong stocks during the correction. I'll leave the link of this in the description. But broadly, this is what you get to learn. There are a variety of things that you learn in this. I think there are about 9 or 10 lessons in it, uh, which you can take up, you can learn from it, and I'm happy to take up any questions after you've gone through the course as well. I do that for my other students as well. And the second one is I put all my trades, all my investments as a journaling of my own into um, a group, a Tag Mango community group, where people follow me to look at what I am investing in and what I am exiting out of. Again, they are real time updates. These are not financial advice. I do want to emphasize on that. This is a community or group that I have created to ensure that I am listing the investments that I make, I am listing the exits that I make, and I am listing the mistakes that I make, right? All my investments are subject to market risk, capital risk of all sort, interest rate risks of all sorts, right? So these two are the offerings that possibly you can look through. I'll leave the, the links in the description section. Next week I'll see how Nifty improves, how the valuations improve, and next week I also will see how the other sectors are doing in comparison to Nifty. So if Nifty is overvalued, are there any other sectors where the valuation is below the median line and they have possible investment opportunities within them? So stay tuned for that. And until that, I'll see you next time to look at similar things and similar learnings. Thank you. Bye bye.